Hey everyone, it's Andrew here with Forma Financial, and we're going to talk about how to reduce risk for more consistent gains. And we're going to talk about this with one simple method, and we're going to compare the results of that method to buy and hold, or what's going to be shortened up to BAH, buy and hold, versus this one simple method that I'm going to tell you about. So let's look at the results to start with. So Apple, if you buy and hold Apple, here's what that has looked like. Let's just boil it down to the bottom line, all right, how much it makes per year and what the worst year was. So the average annual return of owning Apple, 20.27%. Fantastic, right? Well, at some point you had to go through a 79% drawdown or 79% loss in a single calendar year. So the one method that we're going to compare this to, and all these other ones, is called the TV method. And that method, well, yeah, it makes a little less, but look at that worst year. The average annual, 14.53%. Worst year, 9% loss. What a difference. Would you give up 6% a year in exchange for having 70% less drawdown, less loss? Here's Microsoft, 18% average annual return is buy and hold, but 62% drawdown. Isn't it amazing how people forget to talk about drawdowns, forget to talk about the downside and what you have to go through to get there? Everybody wants to make 18, 20, 25% or more, but what about drawdowns? We forget to ask about drawdowns. Worst year, 62%. TV method, yeah, makes a little less, but look at that drawdown, 4%. 11% annual, 4%. IWM, that's the Russell 2000 ETF. Buy and hold that, 8% annual. Worst year was minus 34%. TV method, yep, makes a little bit less, but look at that drawdown again. Only 7% drawdown in exchange for just a little bit more than 0.5% less return. I'll take it. And here's the VTI. It's the Vanguard Total Stock Market. That is the asset used by sophisticated investors. Gives you broad exposure, low cost, fantastic instrument. It's in a ton of portfolios out there. Buy and hold, similar to just anything else, just has a really good structure to it, but it's 8.5% annual and a 36% worst year. Okay, what about this? TV method? Actually, it's higher. Here we're not giving up anything on the upside. We're actually making more, 9.3%. Worst year, 7.93. This is all available data. We're not just picking and choosing here, all available data. Swensen, you heard of him? Swensen, he is in charge of the Yale Endowment, one of the top performing multi-billion dollar funds out there. Buy and hold has done 9.3% with only 22% drawdown, 22% drawdown. Well, what if we apply the TV method to Mr. Swensen's techniques? Actually makes more, slightly more, and cuts the drawdown way down there. All right, much smaller drawdown. Let's look at this visually in case just numbers don't do it for you. Let's look at this visual. The TVM, I'm going to tell you in a second what that is. It's not a mystery, but TVM, look at that minor shift in the return and worst year. Average annual return, worst year. So this is just holding that portfolio and not doing anything with it. And this is the actively managed TVM or TV method. And that is the trade-off. All right, actually here in this, there is no trade-off. It's better on both sides, but sometimes there is that little bit of trade-off. So what is this? All right, so what is this? It's an active investing technique based on target volatility. And that's what TV, so target volatility method. And we also use and talk about it with modern portfolio theory. All right, so David Swensen, he's using modern portfolio theory to an extent, but if we add target volatility to it and we use target volatility method, we can improve the risk-adjusted returns. All right, so let's go through this line by line here and talk about the benefits and how this works. It's a once per month technique. That's it. Once per month using target volatility to make these adjustments. It works on hundreds. Now, it could work on thousands, but I've only looked at a couple hundred. Works with hundreds of stocks and portfolio models. All right, so various portfolio models, modern portfolio theory, Swensen's concept, all these different ones. It works to improve, or at least the difference is subtle, very, very minor, even if it's not an improvement, but across the board, significant improvement to risk-adjusted returns. We all want great returns, but reducing the risk, that is the number one way to improve your performance. Reducing risk and maximizing returns. So let's talk about reducing risk. Let's talk about preserving capital. Let's talk about having capital to put at work. And when you have less drawdown and you can use more capital and you can compound it, that's the name of the game. All right. Uses no leverage or complex strategies. It really is quite simple once you start using it and figure out how to apply it once a month. It does not require any special software. There's no software you have to buy or install or track or anything like that. It's a pretty simple method using most available software just from your broker. And we have hours of training that we've gone through, and we do live support in our group mentoring for anyone who is interested in learning about target volatility method, and specifically the applications we make and how we structure this type of target volatility method. All right, so I'm going to invite you now to come in and start with an introduction and check out target volatility method and how we do it here at Forma Financial and in our community. All right, so here's how it works. We do live group mentoring classes. All right, that's how we do everything. That allows us to share information in the context of the current market, allows you to ask questions. You can have a full-time chat. You can come to the live meetings and ask questions. We cover various topics that way. And they're Wednesdays at 1 p.m. Eastern. And our next one is January 15th, 2020. All right. But don't worry if you're thinking January 15th, 2020, that was forever ago, or it was yesterday. All right. No problem. If you're watching this after the live class, you can still sign up to watch the recording of that specific meeting, this specific meeting we're doing on this topic, and the other meetings that we've had on this topic too. And to try it out, to come check it out and check out our training, check out our group and our support and the way that we work together in a community, I invite you to come check it out with just a $47 one-week trial. Now, can't promise you that's always going to be available, but go ahead. There should be a link there and you can click on that and check that out. If it's still available, please try it out. 1 week, $47. You can watch the recording, you can check everything out, you can check out the community, you can ask questions, and I look forward to having you in there. It's a very exciting, very important topic. I believe that the target volatility method is a way to greatly improve the results of a wide variety of active investing techniques as well as trading techniques. So if you're looking for a way to improve your risk-adjusted returns without something complicated, without some shiny new technique and indicator, just a nice simple way of adjusting your size and balancing a portfolio and taking less risk, then come check this out. All right, hope to see you in there. Thanks for watching, and I'll talk to you later.